Futures and options. You've seen the headlines, right? They're these incredibly powerful financial tools that can create fortunes or, trigger these spectacular collapses. They're really the high-octane engine of the financial world.
But what are they really? Are they a sophisticated path to profit, or are they just a shortcut to financial disaster? That is the big question we're going to tackle here, and we're going to look at both sides of this very, very powerful coin.
Okay, so let's dive right in by building a solid foundation. Before we get into all the wild strategies and the risks, you have to understand the fundamental difference between these two things.
And this, right here, is the single most important distinction. A futures contract is an obligation. You have to do something. An options contract gives you the right to do something. One is a firm commitment, the other is a choice. Let's break that down a bit more.
A futures contract is totally rigid. It's a legally binding deal to buy or sell something. Could be oil, corn, a stock index, whatever, at a price you agree on today for a date in the future. And when that day comes, you must follow through. There is no backing out. It's a done deal.
Now, an options contract, that's a whole different ballgame. It's all about flexibility. It gives you the choice. The best way to think about it is like putting a non-refundable deposit on a house. You've locked in the right to buy that house at today's price. But hey, if the housing market suddenly crashes, you're not forced to buy it. You can just walk away. The only thing you lose is that initial deposit. That's the core idea of an option.
So, keeping that key difference in mind, obligation versus choice, how do traders make their first, most basic moves? Well, it pretty much all comes down to whether they think the market is headed up or headed down.
Think of this slide as your basic cheat sheet. It's pretty simple. If you're bullish, meaning you think prices are going to rise, you can either buy a futures contract or you can buy what's called a call option. That gives you the right to buy at a set price. On the flip side, if you're bearish, you think prices are going to fall, you can sell a futures contract or you can buy a put option, which gives you the right to sell at a set price. So you've got 4 basic moves for 2 simple market views.
All right, but here's where things get really intense. The reason these markets are so famous for both making fortunes and, causing total failures is one single concept: leverage. So let's take a look at the engine that drives this whole thing.
Look at this number, just 2 to 12%. That's the typical deposit, or what's called initial margin, that you need to open a futures position. That's right, with as little as 2% of a trade's total value, you can control the entire thing. Now, this is a really crucial point. This margin isn't a down payment, and it's not a loan like when you buy stocks on margin. It's better to think of it as a performance bond or a good faith deposit. It's cash you put up to prove to the exchange that you can cover your potential losses. And this just shows you the incredible upside. Say you want to control about $32,000 worth of crude oil. You only have to put down around $2,500. Now, if the price of oil moves just $1 single in your favor, you make a $500 profit. That's a nearly 20% return on your deposit from a tiny move in the market.
But, and this is a huge but, leverage is a brutal two-way street, because that exact same $1 move against you, that's an instant $500 loss. Almost 20% of your deposit just gone in a flash. This is how accounts get completely wiped out.
And if those losses keep piling up, you get the dreaded margin call. The clock starts ticking the second the price moves against you. Your account value dips below a minimum level. Then your broker calls and they want more money right now. And if you can't deposit those funds, we're talking sometimes within a day, they will forcibly close your position and lock in all of your losses for you. It's a nightmare scenario.
So besides those basic up or down bets, how do the pros actually play this game? Well, they've got a whole playbook of much more sophisticated strategies.
One of the most common is called trend following. The idea here isn't to predict the future, it's to ride the market's momentum that's already happening. So as you can see here, they'll go long and buy during an uptrend, kind of riding those green arrows up, and then they'll go short and sell when the trend looks like it's reversing, following the red ones down. Then you get into even more advanced stuff, like spread trading. And this quote just nails the concept. Here, the goal isn't just betting on whether the whole market is going up or down. The goal is to profit from the changing price difference between 2 related contracts.
So how does that even work? Well, you might buy a crude oil contract that delivers in December, and at the same time you sell one that delivers in June.
By being both long and short in a related market, you're hedging your bets. You lower your exposure to some massive market swing, and instead you're aiming for a more controlled profit based on how the relationship between those two prices changes over time.
Okay, let's pause. We've talked strategy, we've talked leverage. Now for what is, without a doubt, the most important part of this whole thing, the reality check. Because beyond all the cool strategies, there are non-negotiable rules to this game that you absolutely have to understand.
I want you to just let this quote from market legend Jack Schwager sink in for a second. He's saying that your ability to control your losses is way more important than your ability to pick winners. Managing risk isn't just part of the game, it is the game. And risk isn't just about market moves. Sometimes it's hidden in the fine print. This is a perfect example. Say you make a $15,000 profit trading S&P 500 options. If you did that using an option on an ETF, your tax bill is a whopping $5,250. But if you used a specific type of index option instead, that same bill drops to just $3,900. That's a $1,350 difference on the exact same trade, just because of some obscure detail in the tax code.
So what this all comes down to is disciplined rules. You have to predefine your maximum loss on every single trade using something called a stop loss. You have to diversify. And maybe most importantly, you have got to control your emotions. You have to make your decisions based on a plan, not on fear or greed.
Which really brings us to the final thought here. The world of futures and options offers incredible power, insane leverage, and a ton of sophistication. But it demands absolute discipline and a deep, deep respect for risk. So now that you understand the basic rules of engagement, the real question is this a game you're truly prepared to play?